It's 3 a.m. in Tokyo. A cargo ship full of oil is waiting for payment. The oil isn't priced in yen, it's not priced in euros, it's not priced in yuan, it's priced in dollars. Now imagine one quiet morning, the buyer says we're not paying in dollars anymore. That sentence alone would shake the global economy harder than most wars, because the US dollar isn't just money, it's infrastructure. And if the dollar ever loses control of the world, the question isn't whether America has a problem. The question is what happens to everyone else, including you. Right now, about 58% of global foreign exchange reserves are held in US dollars. Most global trade is invoiced in dollars. Oil, shipping, aircraft, semiconductors, wheat. Even transactions between two countries that have nothing to do with America often pass through the dollar system. That didn't happen by accident. After World War II, the United States emerged with the largest economy, the strongest military, and most of the world's gold. In 1944, at Bretton Woods, the dollar was linked to gold. Other currencies were linked to the dollar. The dollar became the anchor. Even after the gold link was cut in 1971, the structure remained. Oil was priced in dollars. U.S. Treasury bonds became the world's safe asset. Global banks cleared payments through New York. The dollar stopped being backed by gold. It started being backed by trust, liquidity, and power. Here's how the system actually works. If you're a country that exports goods, you earn dollars. Those dollars don't just sit in a vault, they get recycled. Central banks use them to buy U.S. Treasury bonds. That helps fund U.S. government deficits. In simple terms, the world sells products to America and then lends the money back to America. It sounds circular, because it is. The United States gets to run persistent trade deficits. It imports more than it exports. Normally, that would crush a currency, but not when the currency is the reserve asset of the planet. Demand for dollars isn't optional, it's structural. Global banks need dollars for cross-border loans. Corporations borrow in dollars because interest rates are lower and markets are deeper. During crises, everyone scrambles for dollars. Not euros, not yen, dollars. That's called the dollar shortage paradox. In bad times, the world doesn't run away from the dollar. It runs toward it, which creates an uncomfortable truth. Can print the currency the world needs, and the world has to accept it. That privilege has a name. Exorbitant privilege. It means the United States can finance deficits more cheaply than other countries. It means sanctions are powerful because the dollar payment system runs through US-controlled channels. It means global liquidity ultimately depends on decisions made by the Federal Reserve. Now here's the tension. This system is incredibly stable, until it isn't. What would it actually take for the dollar to lose control? Not a tweet, not a single crisis, not even high inflation for a year or two. It would take a slow erosion of trust. Trust in U.S. fiscal discipline. Trust in political stability. Trust that treasuries remain risk-free. Trust that the payment system won't be weaponized unpredictably. In recent years, countries like China and Russia have tried to reduce dollar exposure. Some trade is being settled in local currencies. Central banks have been buying gold at the fastest pace in decades. Regional payment systems are being built. But here's the reality most headlines ignore. There is no real replacement. Not yet. The euro area lacks unified fiscal authority. China's capital controls limit global trust in the yuan. Gold doesn't scale for modern digital trade. Crypto is volatile and fragmented. The dollar isn't dominant because it's perfect. It's dominant because alternatives are weaker. So when people ask, is the dollar about to collapse? They're usually looking for drama. The more interesting question is quieter. What if dominance slowly fades? Imagine global reserves shifting from 58% dollars to 45% over a decade. Trade invoicing gradually diversifying. Oil contracts partially priced in other currencies. Not a collapse, a dilution. What changes? First, demand for U.S. Treasuries weakens. If fewer foreign central banks are recycling trade surpluses into U.S. debt, the U.S. government has to rely more heavily on domestic buyers. That means higher interest rates to attract capital. Higher rates mean higher debt servicing costs. The U.S. already spends hundreds of billions annually on interest. With higher rates, that number compounds quickly. Debt becomes heavier. Second, the exchange rate becomes more sensitive. If global structural demand for dollars declines, the currency could weaken over time. A weaker dollar makes imports more expensive. That feeds inflation domestically. Americans would feel it at the grocery store, at the gas pump, in electronics prices. Third, geopolitical leverage shrinks. Sanctions work because access to the dollar system matters. If alternative payment networks mature, that leverage erodes. Power shifts subtly. Now zoom out. For the rest of the world, a less dominant dollar isn't automatically good. Global finance currently runs on a single deep liquid pool of safe assets, U.S. Treasuries. Break that pool into smaller regional ones and you reduce liquidity. Fragmentation increases volatility. Instead of one global financial heartbeat, you get competing systems, more currency risk, more hedging costs, more instability during crises. Ironically, the dollar's dominance acts like a shock absorber. It concentrates risk in one place. Remove that, and risk spreads everywhere. There's also uncomfortable math inside the U.S. If foreign demand for treasuries falls meaningfully, either taxes rise, spending falls, or the Federal Reserve absorbs more debt. Higher taxes are politically toxic. Monetization risks inflation. Every path has trade-offs. Now here's where public hype diverges from reality. You'll hear phrases like de-dollarization tsunami or the end of the dollar empire. But reserve currency transitions historically take decades. The British pound didn't vanish overnight after World War I. It declined gradually as the U.S. economy overtook Britain's and financial markets deepened in New York. Economic weight matters. Military reach matters. Legal systems matter. Capital market depth matters. Right now, the United States still has the largest, most liquid bond market in the world. It still has a relatively open capital account. It still has the rule of law framework global investors rely on. Those are hard to replicate. So the likely future isn't cinematic collapse. It's a multipolar currency world. More regional blocks, more bilateral trade agreements, slightly higher transaction costs, less automatic demand for U.S. debt. A world where the dollar is still first, but not unchallenged. And here's the quiet irony. If the dollar ever truly lost control suddenly, global panic would likely push investors straight back into dollars, at least initially. Because when the system shakes, people run to what they know. The real risk isn't dramatic rejection, it's gradual fatigue. Persistent deficits, political brinkmanship over debt ceilings, rising interest burdens, strategic overuse of financial sanctions, each one chips at confidence. Confidence is invisible until it breaks. So what happens if the dollar loses control of the world? Interest rates rise structurally in the United States. Inflation becomes harder to tame. Geopolitical leverage narrows. Volatility increases. No fireworks. Just a more expensive, more unstable financial system. And maybe the most uncomfortable implication is this. The dollar's dominance isn't just about American power. It's about global dependence on a single anchor. If that anchor weakens, the world doesn't smoothly transition to something better. It drifts. And the question isn't whether another currency wants the throne. It's whether the global economy can function without one.